Basically, when you buy a house, the house is typically most accountants, like, they'll allocate a little bit for land. Let's say that you buy a $500,000 house. You have to depreciate it over time. So that means the house gets expensed not all in 1 year. You have to expense it over 27 and a half years.
If you have a 30-year mortgage, right?
That has nothing to do with the mortgage.
Oh, so, okay.
Has nothing to do with the mortgage.
Right.
No. So I buy a house. Let's say I buy a house cash, and I'm going to rent it out. I can rent it, it becomes a business asset, right? So it's an income producing asset. So I can depreciate it. So I want to expense the $500,000, but I can't expense it all in 1 year. You have to be earning it.
You can't depreciate if you're living in it only.
Well, let's say I buy a house just to rent it.
Okay.
Okay. So it becomes, because you don't depreciate your primary residence.
That's
right?
what I meant. Yeah.
So it's an investment. So I want to depreciate over time. So the government's IRS says, hey, you could depreciate it over 27 and a half years. Oh, and by the way, you can't depreciate the land. So I have to allocate $100,000 towards the land. Now I have $400,000 of costs that I have to depreciate over 27 and a half years. So a lot of guys do a cost segregation study. So they think, okay, I have to hire a firm. I have to get it professionally done. Some of these on the low end cost like $5,000 to get done. Some on the higher end maybe are 10 to 15 grand. So in my opinion, if you buy a $500,000 house, you don't really need to pay an engineering firm to do it. We did it to your properties. Your properties are all under a certain amount. You can get a good CPA that kind of knows what he's doing, and you can kind of estimate the cost of, how much the carpeting is, how much are the cabinets, so we could do a cost segregation, and you can segregate pieces of that house. So instead of just putting it all $400,000 over 27 and a half, we could take out 5-year assets. So that could be the carpets, that could be some of the floating floors, that could be the draperies, that could be the cabinets, things that are not structurally to the house.
And go ahead. Do you want to say something else?
So I'll put that in 5 years.
Gotcha.
So let's say I pull out 50 grand of those 5-year assets. Now I got 350. I can deduct 100% of that under the bonus depreciation new rule. And then I can go to my 7-year assets. So that could be like the driveway, the fence. That could be other things on the outside of the home that you could depreciate quicker. You could accelerate those things, and you could depreciate those 100% of it in year 1.
So, and real quick, because I'll just so the audience really understands what you're saying here. So, guys, when you buy a house, right? Basically, what depreciation is like. You're writing off the wear and tear that your house is going to experience over 27 and a half years, right? And the reason why he was saying we take a $500,000 house, the reason why it goes to 400 is because the government automatically assumes that 20% is going to be the land.
Correct.
So the other 80% is going to be the actual house. That's what you could depreciate over the 27 and a half years. So you got $500,000, I'll even go easier math, $100,000 house, right?
Yeah.
20% is automatically gone. So now you got that 80K that you can work with.
Correct.
Now you're going to basically go 27 and a half years over 80K. What is that per year?
Let's say $1,600.
$1,600 a year that you're going to save in taxes.
Right.
If you take that $100,000 house, 80% of it, that's the structure. 20% of the land, you can't depreciate land, guys. That's why buying land alone kind of sucks for tax benefits. So that 80% on the structure, then you depreciate that over 27 and a half years. That's $1,600 a year. And then on top of depreciation, you get another bite at the apple to lower your taxes, which is cost segregation. Which, think of cost segregation as like the brother of depreciation that's more aggressive, right?
Correct.
So cost segregation is another way to kind of limit your tax liability that tends to be on a faster scale. So versus 27 and a half years, now it's 5 to 10 years, but it's on stuff that isn't structural. Like you said before, things on the interior of the house, right?
Correct.
Which would be... Give some examples.
So carpet and padding, cabinets that are like you can screw them out and remove them.
Kitchen fixes, right? Bathroom
light fixtures.
Yeah,
correct. Yeah, vanities, things of that nature. You could depreciate them quicker. So rather than getting roughly a $2,000 deduction for depreciation, you can get maybe a $20,000 deduction, which is a huge. Then you offset that against the rental income.
So let me ask this then, just so that they fully have it. So let's say we take it for easy math purposes. Even though you're never going to find a $100,000 house, right?
Yeah.
Now you take 20% remove, we got 80,000. So 27 and a half years, that's about 1,600 a year. Then we get a second bite at the apple with the cost segregation. Let's say we spend, make math easy, 10,000 on the interior of the house on the non-structural stuff, kitchen cabinets, whatever it may be, just for easy math. That 10K that we spent Can we deduct all of it, or
Yes.
can we at
Now,
once? Right?
That's what so now you can do 100% of it. So even
Upfront,
that is
that
quicker
year. Yep.
because that's a 5-year asset. So we should take 20% of it, right?
Mm-hmm.
But now, so under the new bill, you say, no, you could take 100% of it in
And
that
that's
1 year.
under Trump, big beautiful bill.
Correct.
So under other presidents, guys, it would have been that $10K you spent, you would have had to wait 5 years. So let's do the math again. $100,000 house, $20K is gone because of land. The government basically gives you $80K to use to depreciate. $1,600 per year. So you take that off. Then let's say you spend $10,000 fixing stuff inside that's not structural, right? The cabinets and everything else you mentioned. It's up to you. You could take that $10K and deduct it once for the year, limit your tax liability with the $1,600 plus the extra $10K, or you could do it over 5 years.
Correct.
And Trump is the one that basically put it in place where you could take that cost segregation and take all the benefits from it that first year if you want.
Correct.
Because other presidents would be like, okay, you can still, I don't want to use the word depreciate, you can still get the benefit, but it would be over 5 years versus 27 and a half years. So you basically cut more taxes in a shorter period of time. But Trump allowed it where, you know what, we could give you guys one up front where you take that full $10K off your taxes.
Correct.
If they want.
Yep. That's perfect way to explain it.
Yeah.
Better than I could.
Yeah, give me ones if that makes sense for you guys. Because a lot of people get confused with the difference between depreciation and cost segregation. Even me, like I even forget some of the stuff. Like I was in my head, like, wait, can you get it? Can you still depreciate if if it's a 30-year fix? And it's like, no, even you buy cash.
Yeah.
Which now I'm like, yeah, you're right. And then,
But is it better to wait the years or do it right away at the very beginning? The
It
whole 10K?
depends because you could have other rental properties
Yeah.
that are fully depreciated or just producing and they're cash flowing a lot better.
Yeah.
And you want more aggressive depreciation to offset against those others. This typically when you have multiple properties, it comes into play. But the main driving thing here, I want to make sure that you understand is that the with the bonus depreciation is or the cost segregation.
and that's only exclusive to Trump. Has any other president allowed that? Because I remember Trump.
Well,
won,
it
he
came
allowed
in.
it.
Yeah, it came in 2017, so that was under Trump. So this is all the renewals.
He's bringing it back.
Yeah, so they were all going to sunset, after his second term, hypothetically, and then he had that 4-year gap, so he got it all renewed again.
Okay.
So these are great.
I don't think any other president, like guys, if you're a real estate investor or like a business owner, Trump is very good for you.
That's huge.
Like,
It's from a small business. 90% of all business in the America is small business.
Yeah.
So this is huge.
Lots of benefits for you if you're an entrepreneur. For sure.
Absolutely. Yeah, and then
Or a real estate investor.
This is permanent. This is permanent because when we did the 2017 Jobs Cuts Act, it was sunsetting. So we had 100%, then it went to 80, then it went to 60, 40, 20, and it was going to sunset.
So people can
now it's 100%. It's permanent now.
Okay, so people can elect to either get that benefit over 5 years split,
Correct.
20% per year,
Correct.
or take one upfront deduction. And I can see how you can use that strategically. Like, let's say, for example, guys, right? You're going to get taxed to hell this year, right? For other things, right? This is a good way to be like, you know what? I want to cut my tax liability from this angle, and then you could take all that upfront depreciation that year that you're getting taxed to kind of save.
And get an offset, yeah.
Yeah, get an offset. So that's a really good strategic tool that you have if you guys are going to, buy real estate. And this is why real estate's so good, because you could basically get 2 bites of the apple. You can use conventional depreciation over 27 and a half years. Then on top of that, you can add in cost segregation, and then you choose with the cost segregation if you want to do it over 5 years and do it nice slow burn, or
Right.
if
Sometimes you don't need the massive
money.
deduction. And some of these, because it's a passive activity, rental is, you're limited on how much you can take on a loss. So you don't want that bonus depreciation to throw you in a huge loss. So there's ways around it. One of them, like one of the loopholes is going to be like to turn that property into, instead of having year leases, you could do like a short-term leases, like Airbnb type of stuff. I know that's not as sexy anymore, but some people do, well with that stuff. So that turns that activity not into a passive activity. It turns it into a like a business, almost like an operating business. So whatever loss you incur, even if the bonus depreciation brings you into a loss and it's huge, you could take the full amount of it.
Is the goal essentially to get yourself to a part where you got losses? Because that would significantly decrease your liability.
But then you could carry those losses into the future. So that's okay. Even if you generate them in that first year and you get limited how much you can take, you could still carry it forward indefinitely. Okay. So, and then that'll offset future income, future profits.
Okay, so bonus depreciation is back, which is good, and it's here to stay this time.
Then the other big one, which is a real quick one, easy, is it's called QBI. That's qualified business income. So any business activity S corp, let's say, and you have a profit of $100,000, you get a 20% deduction. So you don't have to claim a $100,000 profit in your income tax return. You only claim 80,000. You get a 20% whatever profit you have. So you made 200,000, you only claim 160,000. You get
Nice.
a 20% off the top deduction off your profit.
Yo, W Trump,
Really?
man.
And he made that permanent.
Yo, W Trump,
Okay,
man.
and that is, and see, it's crazy because no one ever talks about any of this shit.
These are
Because the
huge
Big Beautiful
things,
Bill
yeah.
was so
Only the
big
bad
and
part.
comprehensive.
Yeah.
Like, yeah, they only talked about immigration the whole
Ice.
time, and like no taxes on
It's
tips and
crazy,
bullshit
yeah.
like that. But all
This
the
is
other stuff,
yeah.
they didn't mention. So wait, okay, let me make sure I have that right. So you're saying if you decide, so if you want to be an entrepreneur, right now is like the best time to segue and
Well,
get a
no,
side
this
hustle.
has been, but it was set to expire. So he got it renewed and it's permanent now.
So if you generate $100,000 or more, you get a free. I don't want to say free, but you basically get
$20,000 right off the bat.
20K off
Correct.
automatically.
Correct. Yeah.
So they're going to tax you as if you make 80K.
correct.
Now, I'll say this real quick for the audience, so because some of them might be like, "Well, Myron, what's the difference here?" The difference, guys, is that like when you have, let's say, you make 100,000, but then they're only going to make you liable for 80, but you made 100. The reason why that's important is because it brings you into a different tax bracket,
Correct.
Yeah.
right? If you're in a lower tax bracket, you get charged less for your taxes,
Correct.
even though you made more. You should be at the $100,000 range, but now you're at the 80 range, so you're saving a bunch on taxes, and that's the benefit of being liable for a smaller amount.
Yeah, we have a graduated tax. You know, the more you make, the more the higher your effective tax rate is. Some people think that's unfair. They think we should go to the flat tax and make things easy. So
What's the magic number? I remember a couple years ago, it seemed as though if you made like
it's like the
85K or
400
something like
well,
that,
As far as
more like normies, like there was one tax bracket, if I'm not mistaken, where if you made anything over like 85K, it was a significant jump.
well, now it's like around 400,000. So once you get to that 400,000, there's a lot of provisions where they start to phase out. They call it like a phase out where you don't qualify for it anymore.
Okay.
So it's right around that phase, so it used to be like 150 for like single. So for families, like around $400,000.
What's the? I'm trying to think. Like for a single person, there was like one tax bracket where
Oh yeah,
you're like
I remember.
you're
It was
like in a
it was
no
like
man's land.
Like
You
a
make
70
enough to be low.
75,000. I think it was. Yeah, that was like a few years back. I remember that. It
You
was
get
like,
what I'm saying?
Yeah, they've been playing with the rates, and in general, I think they went down even under this 2%, like pretty much across the board.
You're basically like what I call is like the no man's land, because like you're rich poor. It's like you're entry level luxury, but you're also like not. You don't make enough to like sustain that. So it's like and you get kind of burned from both ends because you make just enough to be considered upper middle class,
Correct.
but they're still taxing you significantly, and you don't make the amount of money
Yeah.
that other people in your tax bracket making 100, 200K can sustain.
So I had a friend at my old job,
Yeah.
and we had unlimited overtime, right, at my old job. And the funny part is he would stop working to not hit
To avoid that no man's land.
I was
bracket.
like,
because
why stop working? But it's because it'll fuck him up. Because again, he's gonna be in that no man land where you can't make
Yeah.
much money because you're getting taxed from all
It's
sides.
the worst place to be.
It jumps.
Yeah, literally.
It jumps exponentially higher where it doesn't like it's a diminishing return. Basically, you call that.
Yeah, that's what it is.
Yeah.
I don't know what the number is. I remember before it was like
forgot.
something 80K, but
I know exactly what you're talking about. Yeah.
yeah,
So there
I'm
was
trying to
yeah.
figure out what that number
Yeah.
is.